Good morning and welcome everyone to Moneycontrol live stream. You're watching the opening bell and I'm Santosh Nair. Well, here's a quick look at the trade setup for this morning, and SGX Nifty futures are indicating a bearish start for Indian equities. At this point as we speak, the SGX Nifty is down by close to about 69 points, overall reflecting the weak mood in global markets. Overnight US equities ended lower, and as we speak, Asian markets are also trading lower. Now, back home, technical analysts are keenly watching the 18,245 mark, which is the 50-day moving average for the Nifty, and they're waiting to see if the index will be able to take out this level. Despite the strong rally in the last couple of trading sessions, the index has been unable to get past this level, and this is something that the market is right now keeping an eye out for. And well, with that, we are now joined by the Chief Investment Officer of PGIM Mutual Fund, Srinivas Rao, who would be sharing his thoughts on the year that went by and also what to look out for in the year ahead. Well, Srinivas, thank you so much for joining us on Opening Bell here.
Thank you, Santosh.
Well, so we are in the final days of 2022, and when you look back, what are some of the interesting trends that caught your attention?
Sure. I think we began the year on a cautious note, Santosh. We had a fantastic year, 2021. Corporate earnings have been fabulous. And the back of that, as we were entering 22, I was cautious on what can happen, especially in the corporate earnings front, and also no clarity on whether this COVID will end or not. In addition to those two things, inflation was started to rise, so that was a concern. And there was a fourth element that got added in the year, right in the Feb itself, when the Ukraine war started. So in this backdrop, I thought the current year, 22, would be a very challenging year for markets and economy. But surprisingly, I think things have turned out to be much better than what I anticipated. I think the key highlight would be how corporate India managed all these challenges. Let's say March, April, May, June, we've seen a complete disruption to supply chain. Logistics costs have gone haywire. Commodity prices have run up sharply. So I think the way, for me, the highlight would be the way corporate India has managed these challenges in terms of RM prices and also supply chain shocks, etc. And if you see the earnings, both first quarter and second quarter earnings, we've seen, I would say, the most of the negatives that one can expect from the sharp increase in raw material prices, and the performance has been fairly stable. So I think the year has begun on a cautious note, and we are ending on a corporate India front, we are ending on a marginally positive way. However, I don't think we can take things for granted. There are quite a few challenges to deal with. But net, I think this is the story last 3-4 years, Santosh, where economy may not have done well, but corporates have done well. And the last, I would say, 18 months, economy also has done well, and corporates also have done well.
Well, Srinivas, you mentioned falling raw material prices. Now, which are the sectors that you feel will benefit the most from this trend, particularly of input costs coming down very sharply?
Auto is one sector which will directly benefit from that. I think we are also seeing some benefit coming to energy and chemical companies from this falling raw material prices.
Okay. And now, Srinivas, you've been bullish on the capital goods and infrastructure stocks. Now, does that view still hold?
So I remain positive on cap goods infra. I think we are still at the beginning of the new wave of capex cycle in India. I think the last capex cycle was 2003 to 7. That's when we saw a major rally in cap goods, led by capex in power, steel, refinery, across manufacturing. I don't think we will have a repeat of that, because I think capex in the traditional sectors will remain weak, whether it is metals, whether it is refineries, whether it is power. Power, we are not seeing so much action in traditional, but we are seeing activity in the renewable space. But manufacturing sector per se, the traditional manufacturing, let's say FMCG, pharma, general manufacturing, auto ancillaries are clearly seeing revival, partly thanks to PLI, whether it is electronic manufacturing, or pharma. But overall, I think manufacturing is picking up, and the capacity utilization of Indian industry is close to the peak where they need to start committing for capex, and we are seeing early signs of that. So I think positive on the capital spending side, but I think quite a bit of that is already reflected in stock prices. So to that extent, I would be cautious on cap good stocks. Many stocks are trading at 50 PE plus. To that extent, so the risk reward is not so favorable, Santosh.
Okay, so now also at this point the probability of US slipping into recession appears very high. So how do you see that impacting India's macro, because overall global growth projections too have been trimmed. So how do you see that playing out for India?
Yes, I'm sure it'll have a negative impact. I think IT sector is one sector which we all been watching very, very carefully. So that will we are started to see early signs of that impacting, Santosh. I'm not saying that IT companies growth will decline or they will not grow. I think they will continue to grow. But as can be seen from new order inflows, the commentary that have we've seen, in fact, last 2 weeks ago also, there is a clear slowdown in new orders, and markets are looking at future. So there is a clear sense that new business will decelerate. To that extent, growth rates would lower. So I think recession in US and many other markets seems to be a reality. In fact, Santosh, when I'm seeing top down from Indian markets also, there are quite a few concerns, including the recession, climate change, or inflation fears. But when I'm seeing bottom up in terms of actually studying companies and looking at how their prospect look for next year, next to next year, there is not so much worry, however.
Well, and before I go on to the next question, Srinivas, let's take a quick check on the markets at this point. Markets have opened on a bearish note as indicated by the SGX Nifty futures. The Nifty is down by close to about 70 points. The Sensex down about 250 points. Mid caps are also under pressure in early trades. Nifty Mid Cap 100 down by close to 0.4%. Market breadth negative. We've got more stocks which are down than those which are up. 1,000 odd stocks are down at this point, and about 836 are trading higher. Well, Srinivas, particularly on the IT sector, now this is also one sector which has taken a fair bit of beating during this year. So what are the prospects there looking like? Do you think probably it would be a good time to go around looking for bargains there?
No, not yet, Santosh. I think they've taken a beating for the right reasons. If you see IT sector valuation, let's look at large cap also. Not very long back, they were trading at 15, 17 PE 1 year forward. From there, we moved to almost 30 PE. And as the concerns have started emerging on the growth outlook, we've seen that PE derating happening, and that is what has impacted IT stocks in the current year. In fact, in mid cap space, we've seen even more correction, and which is also right because these stocks have started trading at closer to 50 PM. Quite a few mid-cap companies on the hopes that they can actually deliver faster growth. While certain specific segments they're catering may deliver faster growth, but I think overall company assess delivering 30% earnings growth, I think is going to be challenging. So to that extent, we've seen a sharp correction in the mid-cap IT space also. So my view for IT for 2023 is I will be cautious. I think not a single company has told that we will see a decline in earnings growth or sales growth. The commentary is still relatively positive. I think maybe the first quarter is when we will see one or two companies coming and saying that outlook is becoming challenging. So I think that's when I would start entering or adding more to IT. I think the bad news is still not fully priced in IT sector. That's what is my view, Santosh.
Well, that's an interesting point there. Now, what about the real estate sector? Now, the demand for residential properties continues to be very strong, and if you look at the commentary from developers, they are also sounding pretty upbeat. And the view that some of them are holding is that rising interest rates doesn't really affect demand. Do you share that point of view?
Yeah, Santosh, I agree with all that. I think real estate, especially housing per se, we are in a super bull cycle. If you look at the average size of the flats or houses in India and the quality of the housing, and the changes that we have seen in the last 4 or 5 years, I think the direction is clearly upward for next 5 or 10 years in terms of demand for housing per se. So I'm very bullish on that. Interest rates and the likely impact, it is not big impact. I would say we've seen about 150 bips increase in the interest rate. That does change dynamics to an extent, but that will not be a decision maker in terms of whether to go for a home loan or not. So I don't think that is an issue. But Santosh, the most important aspect is, we are not buying housing, we are buying real estate companies. So when you look at the real estate companies and their valuations, I would say I'm cautious clearly, because we've seen last 2 years the pre-sales number is something that market is very interested in, and those numbers have been great. But enter 2023 and way forward, I think we will see moderation in the pre-sales numbers that real estate stocks will report. And we will also see impact of this higher input prices impacting margins going forward. So again, sector very positive, but in terms of buying real estate stock, linking it to real estate stocks, I'm not sure one should do that. I think it will have a positive impact on the other housing and housing allied sectors more than real estate stocks in near term.
Well, Srinivas, on the issue of interest rates in general, now the widely held view is that whenever rates rise, typically investors tend to take some money out of equities and then invest it in fixed income. And right now we are seeing interest rates steadily inching higher. If you look at the bank deposit rates, they are fairly decent at about 7% for a 2-year deposit, 7% plus for 2-year deposit. What kind of impact do you see this having on the overall sentiment for stocks?
So if the sentiment gets a little bit negative, Santosh, it's okay. I think investors have to focus on asset allocation. Yes, fixed income is today definitely more attractive than where it was last year or last to last year. To that extent, one is trying to increase exposure to fixed income space. I think that's the right thing to do. But impact on equities, I'm not sure, Santosh, because when you're investing into equities, you're investing with a 3 to 5 year view, and that part of your saving where you want to focus on the wealth creation. So there, I don't think we will see a big change in the flows into equities. I think the more important thing is in the last 2 years, investors had a very positive experience by investing into equities and equity mutual funds. And if they see that outlook is becoming challenging and they want to book some profit, I think it's a good thing to do. So because they will, it's not just a notional profit, they would have actually seen the profit coming into their bank account. So to that extent, it is fine. But I think structurally, what has happened in the last 3 years is I don't think that the direction will change. Financialization of savings and that too into markets will remain very, very healthy according to me, Santosh.
Well, Srinivas, so far all the sectors that we spoke about, be it capital goods, infra, IT, real estate, your general view is that the valuations look fairly priced at this point in time. So now, moving ahead into 2023, what does the year look like to you, and which are the areas of opportunities that you see? Which are the key themes that you're looking to play on?
So financialization or banking as a theme, that is one which is very exciting. Overall 23, I think we will see earnings growth closer to 12%, 10 to 12%. I think the street estimates are 12 to 14%. But there are multiple headwinds. If they actually play out, I think we will be happy to see a 12% kind of earnings growth. So to that extent, I think one has to have moderate their return expectations from a pure fundamental point of view. I'm not getting into the aspect that India is relatively far superior, so that can lead to more flows and that can lead to higher valuations. Yeah, that's very much possible. But on a pure bottom-up approach, I would say this is where it looks. And in terms of sectors, I would say, as I said, financials, where we are seeing the credit cost are definitely not a concern. Growth is coming back, and valuations are extremely attractive in terms of given the growth that we are talking. So that is one real sweet spot according to me. After that, we like pharma. I would say it's more of a defensive bet, I think, but pharma is also getting traction both within India and also exports at US. We are seeing improvement, though prices still remain under pressure, but we are still clearly seeing improving volumes in from the US market. So that's another sector that I am positive. Telecom, I think consolidation is clearly done. So we will see numbers getting better there. So telecom is the other sector that I'm positive. And autos is also something that we like. I think numbers have been good in the past, and I think we will see they benefiting from lower commodity prices in the coming quarters, Santosh.
So, when you say financialization, are you saying that banks and NBFCs primarily that you are bullish on, or would you also look at the other sectors like broking and capital markets?
I would say banks and insurance are the two sectors that I'm more positive in that financial space, Santosh.
Well, yeah. Thank you very much for sharing all those insights with us, Srinivas, and hope to catch up with you again on the show.
Thank you for this opportunity.
Well, and with that, it's a wrap on this edition of Opening Bell. We look forward to you meeting you again at 3 p.m. today.